It's been an interesting 4 or 5 weeks in the finance industry, as I'm sure you're all aware. Those that have been looking for finance and arrangements, we have seen a number of lenders withdraw from the market almost immediately that lockdown happened, and some even slightly before that. And then, as in the last 4 weeks, we've had lenders that have reduced their loan to values or increased their interest rates for securities they feel are higher risk. We've had loan to values reduced, we've had valuations reduced. So we've been working hard at trying to ensure that the deals that we do have can still go through, we can make them work somehow, and really pushing hard to get them completed, because you know, it's the most important thing at the moment for us is to get the deals that we have on our books completed, and so that the lenders can't pull out, as we've had quite a few lenders that have been at the stage even when they're about to complete and they have pulled the plug. So we need to be in a situation where we're past that and we're actually, the deal is completed. Yeah, that in a nutshell, that's what's been happening in the last 4 weeks. There are still lenders that are lending, and they are, you know, really pushing hard to get deals. The biggest issue they've got is valuations, and there's the automated valuation system, which is great for residential properties. Not so good if you've got anything commercial in them or a commercial property, but we do also have some valuers that are willing to still go out to property. Not many, but there are some, because the consensus for most valuation firms is that it's not essential, and so they won't go out, but we do know of some that still are. And that then depends on the lender and the type of panel that they have, because a lot of the more residential lenders have panels like Collier's or VAS, and then they're completely closed down. So it's down to, you know, which lender we go with and whether they'll actually accept either an AVM or a valuer that is still working. So that's basically where we are in a nutshell. Steve, do you want to add anything to that?
Yeah, I think fundamentally the risk profiles have changed. Transactions don't exist in the market at the moment. So the point about valuers and having access is one point, but there's also RICS values work on something called the Red Book, which is kind of like the Bible of valuers. And there's a clause that they can add in, which is called the material uncertainty clause. What it says is, we're going to give you this number, but there's material uncertainty in the market. The last time we saw it being used was sort of during the Brexit vote. So it's used very few and far between. What it really means is that, look, we're giving you our best shot, but there's nothing moving in the market. So we can't really give you this price with absolute certainty. And where lenders have what they call caveated valuations, that also means that they quite often may not want to rely upon that. So that's one side of it, that's the technical point. But also huge amounts of the builders merchants have shut down, or you can't get supplies to site. So you may well have 2 or 3 guys who are quite happy to go to site, but if they can't get the materials, it's really causing an impact. So lenders are looking at development sites, residential, commercial, whatever they've lent on, say, okay, we think this site is either stopped or is going to stop. And actually what tends to happen with build costs once a site stops is the build costs tend to go up, and there'll probably be a massive orders for new building materials when the restrictions are lifted that will drive the pricing up there. So if you've got increasing prices on your development and increasing prices for your materials, they're expecting that construction cost overruns will be more regular. And actually what they don't know at the moment is how strong the buyer market's going to be when it comes back. If you read a lot of the data, the buyer market is still there. Everyone's taking a pause for breath. There's still a huge need for residential property in the UK. There's still a huge amount of a need for rentals. So the fundamentals actually underpinning it are strong. And actually, money's never been cheaper. Base rate's 0.1. You know, in my living memory, it's never been, which is a long time, it's never been that low. And it can't really go much further than 0.1. It go to zero, but actually it's not going to make much difference from 0.1 to zero. So the fundamentals for a recovery do still sit there. Cheap money, lots of mortgage lenders who will have, you know, a lot of capital to deploy, new stock coming to market, developers wanting to get a sort of existing or incumbent stock off their books. So the fundamentals are still there, but it's just really trading through the next probably 3 months to see where the market ends out. And as Michelle was saying, where there's no volume, where there's no transactions, and where there's no valuation, actually, the only prices that get reported are really sort of low ones where someone has to take a deal. So it means that, you know, the view is that house prices may do that, but actually on standardized properties, they should be fine. And also rents, there's a concern, obviously, that you can't for 3 months look towards having any evictions. That will mean that lenders are slightly nervous if they don't have tenants paying, whether the borrower can service the mortgage. But actually that doesn't seem to have had huge amounts of impact at the moment. But I think as the months go on, and obviously with a further 3-month lockdown, we might start to see a little bit more pressure on the rental model as well.
I just really wanted it. That's why I wanted somebody else's input, because Steve's got all this kind of knowledge in his head, and I wanted him to impart it over to you today. I really want to kind of throw it open to you guys and say, you know, have you got any questions for us? Is anything going on that you want to talk about in the finance industry, or anything that's happening with you? So open it up to you, really.
We've got a remortgage coming up soon, and that will be in about 3 months' time, and how it's on a residential property, which is a buy-to-let. Do you think we'll have any problems with getting that remortgaged?
I think it will take a little bit longer than you would expect to do. So if you've got 3 months until, is it 3 months until your existing rate expires? Yeah. So I would suggest that you start looking at doing something about that now. We don't know what's going to happen, so we'd probably look at, if you were to come to us, we'd probably look at a lender that would accept an AVM. If it's a buy-to-let, that should be pretty straightforward. I only say it's going to take longer because there's less people working in offices, so everyone's going to have to do it remotely, and that does take longer. You can't just walk around to credit and say, can you have a look at this, can you do that? It's just the time it takes is slightly longer. There is still a lot of lenders in the buy-to-let market that's still active, so I wouldn't worry that there isn't any funds available or that there isn't any lenders out there, but we just need to work smart and choose the right type of lender for you.
Yeah. And did you say about commercial? Sorry, Steve.
As I say, it's just worth saying. So Michelle said AVMs, which is automated valuation models. So there's a few companies. The biggest one is called HomeTrack, but also Zoopla. There's a few others who do it. And effectively, it's a statistical analysis of house prices. So they'll look at what's been sold on in a street and in a location. They'll look at what's on market, and they'll come up with a number. And banks can rely upon these automated valuations. So no one has to go to a site. You literally put the house number in, the postcode, press a few buttons, and you ping, you get a magical number come up. So banks can use AVMs, but obviously the error margin on that sort of thing is higher. So where lenders do use automated valuation models, it won't be at 80 to 90% loan to value. It will be at probably 60% loan to value. So they have a bit of margin sitting on that. But that's what, when Michelle says AVM, that's what an AVM is. Only works for residential.
When they're doing their analysis, have the prices actually come down? I mean, would they have expected like a 10% downward?
I mean, the thing is, it will take an economic view as well. And the hard part is that any property transaction, when you're setting comparables, is backwards looking. So we're in an industry that looks at what something's sold for, not something what it will sell for. So it works slightly differently. So there's very few transactions in the market at the moment. And those that are going through may have more distress on them because someone's having to do something rather than wanting to do something. And that may have an impact of pushing down prices slightly. But if you look at the Halifax House Price Index, or you look at the Rightmove or a lot of the indexes, they're pretty stagnant at the moment. They're not really moving either way, just because there's no volume in the market to really give that new data set.
I've got another question if there's no one wanting to jump in.
There are people that want questions, but you go ahead, Ruth, and I'm sure we've got enough time to get to everybody.
Tracy, you go.
Go on, Tracy.
Sorry. Oh, thank you. Morning, everybody. Nice to see you all on here. Michelle, Steve, hi. My question is, so I've just completed, I feel like I was quite fortunate. My last HMO just completed and we rented the rooms out just before we went into lockdown. So that was really good. Yeah. We are on a bridge with Roma Finance that is due to finish on I think it's early May. Been in touch with Roma and they've been really good actually, and they've said that they're happy to extend the bridge at the current rate with no extension fees, which I think is brilliant, because I've heard that there are quite a few other bridging companies that aren't doing anything for their borrowers. We were in the process of refinancing with Kent Reliance. We'd got to the point where we were waiting for the valuer to go out and do the valuation. There was a bit of a delay of about 10 days, and sadly that meant that we went into lockdown, so we haven't been done. So obviously that's all gone on hold at the moment. Roma haven't said how long they'll extend things for. Of course, it's all very uncertain for everybody, isn't it? I just wondered if you've got any advice. If we, based on 75% loan to value that Kent Reliance were originally offering us, an evaluation that we were looking for, which I think was realistic, we would have been fine. But I'm now concerned, obviously, that A, they might drop the loan to values, and B, we might get a lower valuation, which means that we're going to have to find cash to put into the project for a short while. Just wondered if you've got any advice, please.
Okay, I'll start, and Steve can jump in after. I think, to be perfectly honest, my advice for you is if you can get an extension with Roma, then, and maybe, was it a 6-month bridge originally?
7.
So if you can get maybe another 6 months to see you out of the other side of all of this, let's hope that 6 months is long enough. But if you can get out of the other side, then we hopefully will be in a better position by then, and lenders will be a little bit more relaxed, because right now I really don't think that you'll get 75%. And I really don't think that you'll get a valuation that you will expect to get. And if you can wait, and I know that bridging terms are going to be expensive, but if you can wait, I think that there is a better chance of you getting a higher loan to value and actually getting a valuation that reflects the true value, whatever that is at that time. Because I think that we've got a huge amount of upheaval to go through. And I think that this time next year, we may be back on an even keel, but I really don't know how long all this is going to last for. I think the repercussions are going to last for a long time. But I know that at the moment, excuse me, you will struggle to get 75% at the moment. And what type of property did you say it was?
It was just a small HMO.
Right. Oh, it's a HMO. Right. Okay. So I don't think you can do an automated valuation on a HMO, but no, you can't.
Right.
So you will be a little bit stuck at the moment. And if you decide to go ahead now, you really are stuck with the number of lenders that will lend to you, and also the loan to value, and the fact that you can't get a valuer out, or you might get a valuer out and they might well give a value that is nowhere near what you need, and you've paid for something that is almost irrelevant to you right now. So Steve, would you say anything different?
No, absolutely not. I mean, I think the interesting thing is how, if you look at sort of clearing banks, we know how they're funded by deposits, they've got huge capital bases, and so are challenger banks. When you look at bridges, lots of them are funded by what you might call private equity or wealthy individuals or things of that nature. And they've had a really good run over the last few years. They've been getting really strong returns at, fairly good risk-adjusted sort of, 70% loan to value and 1% a month type returns. And we know the guys over at Roma, we know Scott, I think what most of the bridges are going to do is, rather than crystallizing, because if they could say, okay, I want you to refinance, they know as well as anyone else that there's no one out there to do that at the moment. So if they say, we want you to refinance, and you come back 2 weeks later and say, I can't, they're in exactly the same position, but they've lost their borrower's respect. We're seeing a lot of the bridges coming out and actually, but you know what, we aren't really wanting to do this, but we will extend for 3 months or 6 months. We might want to stop rolling up interest. We might want to pay interest on a monthly basis if you've got the tenants in and you're starting to get an income. And I would recommend that, because otherwise your debt will start to go up. But yeah, I think I completely agree with Michelle. I would go for the longest term you can with Roma. Make sure they don't add on any exit penalties. And then as soon as the market starts to see some return to normality, speak to us and let's get you out.
Lovely, thank you. That's
Guys,
great.
if lockdown finishes in 3 weeks, which I'm really hoping, Boris is going to come back, we're all going to be fine in 3 weeks. Do you think that'll? It's not going to happen, is it?
No.
Steve?
No, it really isn't.
I'm with you. Let's be positive.
I know. I love your optimism, Ruth. I love it.
Boris is going to ride in on his white horse.
Yeah, he's not a miracle worker, and I think that we are. I really wish I could say to you, do you know what, guys? By this time, September, December, August next year, everything's going to be tickety boo. But I just don't know. I don't know, Steve.
I'm liking it to, I probably use this too much, but it's kind of like when you're sitting on the plane, you're sitting on the runway, and the pilot comes on, he says, oh, there's a couple of problems, but we're going to be in the air in 30 minutes. And you think, okay, that's fine, 30 minutes isn't too long. And 30 minutes later, he's like, oh, yeah, a couple of more things, another 30 minutes. And 4 hours later, you've had 30 minutes, but in your head, each time he says 30 minutes, you're like, oh, that's not too bad. And this is what I think 3 weeks is. 3 weeks is not a month. You think, oh, 3 weeks, it's not too bad. And so you can keep rolling it. I think if you look at what's happening in Europe, you're starting to see some countries reduce their lockdowns. Denmark, children under 11 are going back to school. Sweden hasn't really enforced any kind of lockdowns. Lots of people are saying we want to start reducing. If you saw Trump's briefing a couple of days ago, the US have set 3 different phases for releasing it. And a lot of the words that are coming out are the cure shouldn't be worse than the illness. And the concern that everyone has is almost down. The worse the economy is. And actually, the money that the governments are borrowing now, 330 billion in the US, 2 trillion in the US, that's not children. And the other thing that people are waiting to see is what's happening in China, because China and Wuhan has just reopened, and actually they've had a second round of infection. So I think what they're going to do is take a bit of a wait and see brief, see what happens across Europe, and then make some decisions based on that, because you have to make it on empirical data rather than a set of assumptions. So yeah, I don't think it's going to be for the rest of the year, but I'm pessimistic. I don't think children will go back to school before September. I think we'll probably have another 3 weeks at least after this, and then I think we might start to see some relaxations. But actually, how do you police it? How do you agree who's a key worker, who's essential, who's not? Who goes back when? And they're all the questions that no one's really come up with an answer for. So yeah, I'm more pessimistic. I'd love to be out in 3 weeks, but I'm more pessimistic.
Yeah.
There was a question on the chat just about mortgage payment holidays. Do you think that the lenders will look kind of adversely at you if you do take a payment holiday?
They're not supposed to. So when it came out, it said that it shouldn't impact your credit score or your standing with the lender. But if you look at all of the things that have been promised, CBILS, which is the Corona Business Interruption Loans, mortgage repayment holidays, cessation of evictions, all these sort of massive measures they've brought in, at the moment they're lovely words, but no one actually knows how to do the policy for it. So in terms of the Corona Business Interruption Loans, there have been 170,000 applications to all the banks. There have been 1,000 cases looked at, or 1,000 cases agreed, which was publicised last week. And the banks are suddenly realising, oh my God, how do we actually start this? How do we manage this process? Because what they need to do is massively ramp up their risk teams, massively ramp up their client servicing, but everyone's at home. So you've got all of these sort of weird and wonderful issues happening. And we haven't seen really what it actually physically means, but the way the policy was drafted was to say that it shouldn't impact your credit score, it shouldn't impact you. All it will mean is your interest effectively gets added to your mortgage and you've got slightly more to repay in sort of 3 months' time, but it shouldn't be a problem.
Fantastic. Questions, anyone? Questions?
Yeah, I've got Julia. Julia Weatherall's got a question. Julia?
Hi.
Hi.
Can you hear me? Hi, can you hear me?
Hi, Julia.
Hello there, hi. So just a quick question. So my sister and I, Justine, we were literally about to complete on an 8-bed HMO as the lockdown happened. It was everything was ready just to be signed, and it was that day kind of thing.
Yeah.
The lender, Octopus, pulled out on the bridging. So I'm just, but the thing is, our builder's still going. I'm wondering whether he's really keen to keep, to get it sorted. I'm wondering if it would be a stupid idea to look at other finance and think about whether we could get something going at the moment, or do you think it's going to take too long and it's no point, and we should just wait for Octopus to reopen?
Right. Oh. It's such a hard one. So have you had a valuation?
Can I just jump in and say something?
Yeah, that's my sister.
Can I just say something?
Yeah.
Hi.
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 Just to say, they've said that they've paused it, not cancelled it, because all the valuation and everything has been done.
Yeah.
Sorry, I'll butt out now.
Okay.
Yeah,
No,
we have seen that a lot across.
Yeah.
Octopus have done that pretty much across the piece.
Yeah.
But they have also pulled out on clients who have already exchanged. We had a few cases where clients had exchanged and Octopus pulled out as well.
Wow.
So this isn't uncommon.
No. In fact, we spoke to a client yesterday, and they had they were one day away from completing, and Octopus said no, we're just not doing it. So unfortunately, you're not the only ones. Now, the thing with Octopus is they have said, and they've made it very clear, that it is a pause, it is on hold, and they're just waiting to see what happens. Now, for the time it's going to take you to go to another lender to get approved, to see whether the valuation, and the other thing is, if you've had the valuation carried out already, the other lender would need to accept that. The valuer would then need to be able to retype it to the new lender, and it's very possible that they will put the clause in that Steve mentioned earlier that basically null and voids the valuation. So I suppose it's coming back to, it may well be better to wait it out with Octopus and see what happens. What we're doing at the moment is we're trying to get in touch with them kind of every 3 weeks or so to see how their stance is, what they're thinking, when they're going to be looking to come back into the market. But for the length of time it's going to take and the cost involved in starting with another lender and their fees, unless you are really, it's urgent that you get this refinance through, then I think my advice to you would be try and stick with it, because if you are that close, you still will be that close when they're back in the market.
Okay, thank you.
Steve, would you?
No, I completely agree.
Yeah.
Okay, thank you.
Okay, I've got Justine Kirkham. Question from Justine.
Hi.
Hi.
Sorry, it was the same question that Julia had asked, so we're all good.
Okay, excellent. Vicky and B from BV Property.
Hi.
Hi.
Thank you. Hello. So we are in the process of purchasing HMO right now, and we actually got options for lending, which is really good. Yeah. And the valuer can come to the house as well, which is another very good point.
Excellent. Is that because it's empty?
Yeah, no, so he said he can come, but he may not go inside. But it's the same value because we bought another one on the same street, like 5 doors down, and it's the same value that did that one. So we're hoping that with his knowledge and experience on the other house as well, it's kind of a very similar house, and he's already done that one. We're thinking, but your advice would be great, that that would help.
Okay, so it's a HMO.
Yeah, and basically the question we have is we got 2 possibilities. Actually, every day the broker comes back with different options.
Yeah, I bet. Yeah, this one's gone. How about this one? Yeah,
we decide on one. It's like, another one's popped up now. I'm like,
yeah.
So we got 2 options right now. One is Redwood and the other one is LSC, and they both lend 60% of the purchase price.
Yeah.
One, and we do development finance as well. So LSC gives 100%, but it's more expensive on the cost. And the other one gives only 70%. But what we're thinking is Redwood is assuring us that we can have a refinance afterwards.
It's a bridge to let product.
Yeah.
Whereas LSC, we're not sure. So our question is it better to go with the refinance option to be sure, even though it can be a bit less attractive? Or is it better to just, we don't know?
Because Redwood are offering on the back end, it seems to be about 65%.
Yeah. So the first thing I would say to you is that it depends whether or not they're guaranteeing the back end, because there's a lot of lenders out there that will do that, a bridge to let, and or develop and then term out at the end. So they will do that, but it depends whether or not they will guarantee it. And it's very difficult for them to do that, because by the time it comes to the refinance to a term loan, who knows where we'll be. I mean, if you can think of now and then 6 months and 12 months, the world's going to look different almost every month. So it's very difficult. But what I would say is to go with a lender that already has long-term products is a safer bet for you than a lender, because you keep your costs down. They already hold the security. So refinancing onto a long-term with the same lender, or taking it out from a bridge to a long-term loan with the same lender, will definitely keep your costs down. Whether or not Redwood is not the cheapest on the market. It's a stable lender. They are middle of the road. There's nothing very exciting about them, but they do what they do. They're still funding right now. They're still funding, as you know. They may have reduced their interest rates, and they may be wanting a little bit more information from people, but they are very much still in the market, and that stands for a lot at the moment. And to go, if it were me, I'd always try and keep with the same lender and push it all the way through from start to finish, and that way that lender already knows you and makes it easier. If they already know what the security is, it's very unlikely they're going to turn around and go, no, we don't want it on a long-term loan.
Yeah, true.
Makes
That's
sense.
good advice, because we're taking out a 12-month bridge. So we're thinking, obviously, in 12 months' time, hopefully things will be better. But even if it's a low GDV, at least we know we can get off the bridge. And onto something, even though if we need more money in the deal, that's just a decision.
And the good thing about Redwood is that they sometimes allow you to have an interest-only period on a term loan. So if you haven't got that currently, ask your broker to ask them about that. If there's enough in the loan and the loan to value, they can do maybe a 1 or 2 year interest-only period. And the other thing with Redwood is you can have quite a short term. So your tie-in period will be for the term of the loan. So you could have, for example, a 3-year term, a 3-year tie-in period, and after that time you could maybe zip onto a lower interest rate with another lender, so they can get you through the tough times, and then you can see about maybe refinancing onto a better rate.
Good. So having a shorter term when we on the back end, so that we have options to move it to someone else after. Or you can keep the term high, but ensure that the repayment penalties are for, say, 3 years. So maybe go for a 3-year fix with a 3-year tie-in, so that you know that after 3 years you're then free to move to somebody else if you want to. That's great.
And just look at the conditions around the conversion. So within a facility letter, you have 2 things. One's called CPs, which is conditions precedent, which is things you have to do to get the loan. And this thing's called CSs, which is conditions subsequent. So where you have a loan that can convert, it will say you've drawn down your bridge, but you must do A, B, and C to convert. So just look at what those conversion rights are. So it might be that your loan to value on a revaluation is not more than 65, and you've got a building certificate or whatever it may be. Just make sure you're happy with those. But I completely agree with Michelle. Don't trade certainty for uncertainty, and by that I mean don't trade Redwood, who will do both sides of the coin, with someone who will do something slightly more whizzy on day one, but you then have another refinance hurdle.
Yeah.
Perfect. Thank you very much.
Excellent. Thanks, guys.
Thank you.
Thanks for the advice.
Okay, I've got Kev. Kev?
Hi, I'm not Kev, I'm Eva.
Oh, I'm sorry. That's what it came up with. I'm so sorry, Eva.
My husband's.
Wonder.
Hi, a really basic question. So I bought a property, I've converted it into an HMO. It's a small one. I was very lucky, I bought it with cash. Been a landlord for nearly 6 months, and I can then refinance it in sort of June, July time. So to get a mortgage on it. The issue is, if myself and my husband have lost their jobs because of COVID, what effect will that have on refinancing, if at all?
So if you have you been furloughed, or have you been made redundant, or
Both redundant, yeah.
no, both redundant? Okay, so a refinance will be tricky,
Right.
because most lenders, so this is for a buy-to-let rather than a personal residence.
It's a buy-to-let, yeah. It's bought through a limited company.
Okay. So some limited company buy-to-let lenders will want you to have a minimum income, and some don't. So it's not necessarily something that we can't help with, or that lenders can't help you with. It's just choosing the lenders that don't need you to have a minimum income amount.
Okay, so there are some around that.
Yeah, because some lenders will rely on the amount of rental income coming in to service the loan and don't worry about anything else. But more lenders actually want to be sure that if there are any voids, that you can make up the difference. So it might be that they'll say, we need you to show that you've got, say, 3 months of void payments in an account somewhere, and show that you've got that. So there's sometimes there are ways around you not having an earned income. But yes, in a nutshell, there are lenders that will still allow you to refinance a buy-to-let without any income.
Okay, thank you.
You're welcome. Natalie Gascoigne.
Yeah, hi everyone.
Hi.
I was just asking, it's probably not a question for now, but it would be really good to know once this is kind of nearly all over. I think the lenders who were most supportive, because whenever I'm looking at kind of like, you know, bridging finance or development finance, for example, I was talking to Together and Roma in our last development, and Roma were very much saying, although, you know, if the rates are the same, go with us because we offer the best service and we really work with landlords if there's any problems. And it's just, I think now's the time to kind of prove how good a lender is and how supportive they're going to be through like a difficult situation. And so, yeah, it would just be good to know almost where the red flags are, and which lenders have been particularly helpful for future projects.
Yeah, it's a really hard one, because some lenders have taken the stance, like Roma, like Together, like Octopus, that we are not going to be lending. We're not doing any new lending. That's it. We're just going to concentrate on our existing clients, making sure they're okay. So it's what side of the coin you fall on there. Do you think that's a really good thing, that they're just looking after their clients, the ones that they've already got on their books, and making sure they're okay? Or do you think that because they've closed their doors, they're not looking after the people that need finance? So it's a really tricky one. And then you've got the ones that are that say they're lending, but you know they're not. And then you've got the ones that are lending, but are lending at reduced loan to values and probably responsibly lending.
Yeah.
But then again, they might not help you, because although they're responsibly lending, they might be lending at a loan to value that's not going to help you. You know, maybe they'll look at the valuation that you may have got just before this happened and say, we're going to take 20% off it. So it's a really hard one to nail down. Yes, we have had lenders that are still actively in the market, but now they're coming up to all the stages where they need their properties valued. and it's like everything's now on hold. We've got to this stage, but we can't do anymore. So it's hard. Steve?
I would say also, if you look at where the market is at the moment, although we're sort of 3 or 4 weeks in, there hasn't been that much distress in the market recently. So the market has carried on. People have probably used savings to pay mortgages, or they've been engaged early and they're doing what they can. The longer this goes on, obviously the higher the number of distress cases that banks are going to have. So at the moment, the banks are also, I'd say banks, the lenders are sitting there thinking, okay, what have we got on our books? And they'll put it into 3 pots. And I used to run a bank, so I ran a bank through the GFC. So you have okay, this is really low risk and this is fine. We don't need to worry about this pile. And that's you put it in a box and you kind of file it over there. Then you've got this might not be great, but I think if we can do this and this, it'll be okay. And then you've got oh my God, what have we done pile. So at the moment, there's not that much distress, but the banks are working out what box things are sitting in. The longer this goes on, the more they're going to start looking at the oh my God pile. And what you're going to see is lenders who've been responsible on the way through, who've got what you might call a balanced book, will be able to trade through and be able to be more helpful, because actually they might have a bit of a fire, but it's under control over here and they know what they're doing. Where you've got lenders who've been very aggressive on the way through, they're going to have a lot more things in the oh my God pile, and they're going to be a lot less able to be sort of helpful, because their funding lines, i.e. the people they borrow from, are going to be saying, are we going to get our money back as well? We want our money back. And we saw there was I don't know if you're aware, there's a bridging lender called Amicus, and they probably had more in the things of the oh my God, what have we done pile. And when times got slightly harder, they were okay, their funders were like, we want our money out, just get rid of the book, sell it very quickly. And at that point, the lender and the client and the contact services that you had fall away. So it's hard to say who will be there. Together are absolutely massive. They're a really strong business. Roma are a much smaller business. You've got so many different counterparties in there. But what we don't know at the moment is who's going to survive and who's going to sort of be there the longest. But what we would encourage everyone to do is, if you have got a short period where you have a refinance or an extension, engage with the lender, speak to us, see if we can engage with the lender and try and get that lender to extend for 3 or 6 months to give you that breathing space, rather than getting to that 3-month period and then thinking, okay, well, these guys, no one's in my market doing it at this point anymore. What do I have to do? So we always think early engagement is the key. And if you're having problems with particular lenders, pick up the phone. We'll tell you, we see if we know anyone there. You mentioned Roma, so we know Scott. We know the guys are together really well, and we can have a quiet word.
Yeah, for sure.
Great, thank you.
Okay.
Yeah, thank you.
Claire, I'm sorry I missed you from earlier. Claire Norwood.
Thanks, Michelle. Sorry. I think possibly my question might have been answered by Stephen just then, but we've got 2 development sites currently partway through sort of an 18-month term, and it's all been running well, but obviously the sites are now closed down, and both development lenders are alternative, so their shareholders are peer-to-peer platforms, and I know already there's sort of signs that behind the scenes drawdowns are late, and although drawdowns have stopped now, the last few we've just felt a bit touch and go, and I'm just wondering, are they going to see it through? Are they going to call in loans given that they're both uncommitted, not ring-fenced, or should we be looking at ways of jumping to another lender, or should we be worried? That's my question.
Okay, Steve, do you want to jump in on that?
Yeah, I mean, development is posing some problems because the bank's monitoring surveyor obviously can't go to site, or may not be able to go to site, so that's slowing matters down. The comfort that you kind of need to take is that actually a part-built site is probably worth materially less than the bank have lent you on it, because actually your premium only really kicks in at the point that you kind of put the final brick in and it's ready to go. So that's more problems for themselves, or what lenders cause more problems for themselves, jumping in early and leaving a half-built site, because then the only people who want to take it on are people who want distressed sites. And also, if you have to stop and they try and bring someone else in, the new purchaser, the new counterparty isn't going to get collateral warranties, build all the things that you have to have, because basically they would have walked off with you. So I think they're going to be slow. Also, part of the reason they're slow is that, like Michelle said, they can't walk over to the finance team and say, oh, here's a drawdown, can you pay this? They're now emailing that to Barry in accounts, who's then sending it over here, and it's kind of doing that. So things are going to be slower. I would probably engage with my lender and just pick up the phone and say, we've got a development, guys. This is where we are. This is our update. We just wanted to check to make sure you're still happy to be here. I certainly wouldn't advocate trying to refinance during a development. It's really, really problematic and challenging. Yeah. And most lenders, to be honest, if we went to most lenders in the current market and said, how do you fancy refinancing a part-built development? It would be a really short conversation and the final word would be off.
But Stephen, what about in our loan agreements? There's a date by which you have to start repaying the loan. And what if we're now looking at thinking, I don't know if we're going to make that date? Do we then negotiate an extension?
Yeah, I would be in contact with the lender now and say, guys, I've got, my date for completion was this. This is what's happened on site. This is where we are. Give them a decent update pack. Go and take some photos of the site if you've got them. Get your last contractors report. Get a decent information pack and say, this is where we are. We think we need to move this date out to. And if you think you need to move it to December, take it to March. Push out further than you need. Yeah. But early engagement is the key at this particular point. Who are the lenders on it?
Rate Setter and Zorin Finance.
Okay, so Zorin, we know the guys fairly well. Rate Setter is still peer-to-peer, isn't it?
Yes, although Zorin actually is peer-to-peer as well, one step back, I believe.
The harder part for peer-to-peer depends how they raise their money. So you mentioned uncommitted. Pretty much every development facility is deemed as uncommitted. What that means is we haven't put the money in the account to make sure you've got it all the way through. We'll fund it month to month.
Yeah.
Some peer-to-peer funders actually go out every single month and try and raise your drawdown. And that's more challenging at this particular point in the market because there's a smaller pool of investors wanting to do that. So that may slow matters down. But yeah, I would engage as early as you can, give them a really good update, give them a decent pack and say, I want to get your commitment to move forwards on this as well.
Great. Okay. Great.
But we haven't seen, we know Luke over at Zorin, we haven't seen, I haven't seen Zorin pulling out either at the moment.
No. Okay.
And just while we were talking about sort of lenders extending, Caroline, you dropped on about you had 3 bridges with Together, which run out later this year, already offered to extend for another 12 months, but warned there'll be a 5% penalty. I think lots of bridges who are extending are going to want their pound of flesh. I think % is material and probably higher than I'd want to pay. But if you look at what we call friction costs, which are the costs of going from one lender to another, where you're going to have a new valuation problematic, new legals taking longer, credit taking longer. Actually, if you can extend something, then if you could get that extension fee down to 2 or 3%, that's probably no more or less than you'd pay refinancing it, and I'd take the certainty.
Yeah. And I think what Steve just said is absolutely key for whatever type of loan you have is communication with the lender. Whether it's your regulated house loan that you live in, or it's a buy-to-let, or it's a development, or a HMO, or commercial. Communication with the lender is key, because if you do want them to help you and extend or do something, if you've been in touch with them and kept them up to date, they are more likely to want to help you than the people that just turn up with 1 day to expiry and expect the moon on a stick. So just remember that, guys. Keep the communication going. Karen Gill, got a question?
Hi there. Yeah, mine's about 2 units that we've just completed. One's a commercial unit, one's a residential unit. Before the lockdown, basically, we just put it up for sale, and then lockdown literally happened a few days later. So we've not really got any buyers as such, but they've got lots of interest because it's quite high end. It's in West London. There's a lot of demand for commercial and residential. But my question is, we've got a PCC actually, and we've got the building reg certificate. And we actually had, because it was an old chartered surveyor's office originally that we converted, he wanted to just come in and just view it, just to see what we've done. So he's qualified, chartered surveyor, and he was blown away by the actual quality of the build. Because he's seen it, but he didn't come in professionally to see it. I'm just wondering if we can utilise that and sort of reach out to him and say, hey, you've come to see the unit, would you then take it on as a valuer? Is that kind of possible? And is that a good idea to do for sort of like, can we get that kind of valuation, and would it help our sales? Can then we give that valuation to any sort of potential buyers? Would that help us in any way at all?
Steve? Over to you.
It depends. So it depends whether he's a qualified valuer.
Yes.
And he's an authorised valuer.
Absolutely. About 30 years experience.
I mean, what do you hope to achieve by getting? Because basically, if you take something to an agent, you'll get an agent's value, opinion, and normally an agent will have a higher valuation assumption than a valuer because because of the way that they work.
Yeah.
The only way it might be helpful is if you were looking for finance on it, and you could say to the guy, "What lenders panels are you on? Now you've seen it. Could you do a lender's valuation?" And you go to that lender and say, "Can you use X? He's already been to site." That might help speed you through.
Mm-hmm.
Especially if he's done that. But I don't think giving I don't think giving a valuation to a buyer from a chartered surveyor is probably going to help at this time. You might want to say to any buyers, look, we have had a couple of valuers around and one of them might be able to work for you. But if he's a small sort of one-man band with a small company, it's highly unlikely he'll be on a lot of lender panels.
Well, they're very successful. They've been around for about 40 odd years.
Mm-hmm.
There's a team of chartered surveyors, so it's not one man band.
Oh, okay, that's fine. So find out what panels he's on. That might be quite helpful because you could say, actually, there's a valuer who has already been round. It's this, and if you say to your valuer, what lender panels are you on? Then you can probably say to them, we know he works for Barclays, NatWest, RBS, whoever it might be.
Right.
The hard part is that most of the big lenders, most of the big mortgage lenders, they have a valuation system. So they type in an address, it goes to a big system, the values 365, or there's 2 or 3 others, and they'll just apportion it out to whoever's got work or availability. So you'd need to be very specific on that to say, we would like you to try and use this valuer. And you just need to be careful that having been around it for you, that he's not in any way conflicted. And so he can't refuse to say I've got a conflict of interest, which I don't think he probably has.
No. But the thing is, we've already got private bridge on there. So we're very fortunate that our private bridger is, willing to roll on the interest. So whenever we sell it, it's just going to carry on rolling on. So we've got that kind of security. We've got cash, some to sort of carry us over for a while. But ideally, we're thinking flat, obviously once the lockdown is done, we're not sure if the commercial unit will sell because the way retail is at the moment. But we're pretty certain the residential 1-bed will sell. So we're thinking if we wanted to refinance, what would be the best way? Or should we continue just rolling it over with the bridger that we have, in your opinion?
I think we'd probably just need to see the property details, valuation, what you need against it, and actually to try and do a treatment on it to see who would be in the market at the moment. And then we have to do a compare and contrast with what you've had. I think the message that we've been trying to portray today is if you have got something in place, don't go to market unless you absolutely have to. So if if your private bridge is happy to extend and you have that, then I'd rather have, as I said earlier, don't trade certainty for uncertainty. But if you have the details and you can sort of contact Michelle after this, Michelle can have a quick look and sort of say, actually, this would work with X or whoever it might be, and we can see if there's any options out there for you.
Thank you very much. Thank you.
Yeah, sorry, this is not COVID related, so I hope it's okay to kind of ask away on that one.
Of course.
We've got a development in Wales that has been shut down because of COVID, and we were very lucky that we got a grant to give us 70% of the build cost on this particular project.
Okay.
And but one of the caveats is that you have to rent out the property for 5 years. After the build is completed, and then you kind of keep the grant. Because you kind of know a little bit about mortgages and refinancing, one of the things is they want a what do they call it? A charge.
Yeah.
On the property for the 5 years. Do you think it's still possible to refinance it?
Well, I'll let Steve come in on this because he probably knows, but I would imagine it would depend on the type of charge that they want. And if it allows a lender to have a first charge, but there it's just maybe a restriction on the title or something like that, then it might be okay. But Steve, what are your thoughts on that?
Yeah, no, I mean, it's not uncommon for local authorities to want to take security where they have put grant money in. So the normal format is that they'll take what's called a second charge. So your mortgage on your house is called a first legal charge. All that means is if they have to sue for possession, they stand first in line. Second legal charge is any money left after the first goes to the second charge holder, and it's still a restriction. So What you have to do if they will accept a second charge is there's a document between the first and second charge holder that regulates how they act, which is it's either called a ranking agreement or an intercreditor. And as long as the local authority is happy to enter into that, then that's absolutely fine. The only other way the local authority can take security, as Michelle said, is to put a restriction on the title, which is sits on land registry, and it will say something like no disposition of the property may be made without the consent of. So it depends what exactly they want. Yes, it is possible. It also depends on what type. So if they will do a second charge, what you then have is a priority. So let's say the property is worth 150. If your first mortgage is 100 and your grant is 25, then the first charge holder will say, okay, I want my 100 plus 10%, because if they do have to roll up interest, they want slightly more, and that will show the second charge holder still has enough capacity in their charge to get their money back. So the answer is yes. The answer is that we need to engage with the lender on day one and say there will be a second charge for the local authority in relation to a grant, and that you'd need to say to the local authority, that's absolutely fine. However, you will have to have a second charge on this and make sure that they're content to have that. If they want a first charge, then it's much, much harder.
Okay, thank you very
We
much.
need to look at the charge agreement.
Yeah.
Okay.
Which was it over? I'll squiz through it for you.
Thank you.
All right, thank you. Cheers.
Okay, no worries.
Guys, that was an absolutely brilliant session. We've done our hour, just over an hour now, so thank you very much. And I think we should have you both back in a month or so to get an update again to see where we are, and plenty more questions. I thought that was a really, really fantastic session.
Good.
So big thank you to both of you guys.
Thank you for inviting us.
Everyone else as well. Have a lovely day. That's it.
Thank you. Thanks, guys.
Thanks, guys.